Good day, ladies and gentlemen, and welcome to our class 2 of our series on chart patterns, or the basics of chart patterns. And today we're going to be looking at the head and shoulders pattern and a couple other patterns like triple tops and triple bottoms, maybe double tops and double bottoms. We're going to leave the extravagant stuff like cups and saucers to our next class. And we've already had class 1, which is focused on triangles. So I would appreciate it greatly if you could click on the bell icon down below or just hit the subscribe button. It's very important to me. I promise you, I don't send you any emails. I won't bother you with anything. You'll just get a notification when I upload a new video. So please subscribe. So let's get on talking about chart patterns and interpretations. Now, technical analysis refers to the study of financial markets based on price movement. It uses the assumption that the price of a share or an asset reflects all the information about that asset, including market sentiment as well as perceived value. Charting refers to technical analysis that is performed through careful inspection of share price data for identification of well-known patterns that emerge in price. For example, heads and shoulders, channels, triangles, and wedges. Now, like I said, our first class we discussed triangles and wedges. Today we're going to spend more time on some other patterns. Now, chart patterns are well documented in technical analysis literature and are based on the psychological phenomena that occur between buyers and sellers of financial markets. Patterns formations do not form a trading system, but rather provide an indication of future trend of the asset as price breaks these psychological barriers known as sometimes as support and resistance, or as price levels. Now, there are numerous types of patterns, all named according to the shapes that the price graph form between the support and resistance lines. The general types of patterns include triangles, channels, wedges, and head and shoulders. So we covered in depth in class 1 triangles. We looked at ascending and descending triangles. We looked at how to use them in our trading. We looked at briefly at channels and rectangles, because a rectangle and a channel kind of fall into the same understanding as triangles. But rectangles and channels are sometimes known as flags and pennants, depending on the slope of the initial trend and the slope of the breakout. A flag would be identified as a bullish continuation channel down. Wow, that's a mouthful, isn't it? Or a bearish continuation channel up. A pennant would be defined as a bullish continuation triangle or a bearish continuation triangle. Okay. That's why I don't spend any time looking at pennants and flags, because they are a mouthful. I just call them all kind of triangles. Same thing with wedges. Wedges are similar to triangles in that these patterns are formed between converging support and resistance lines. The biggest difference between a wedge and a triangle is a triangle, in a symmetrical triangle, the degree of the angles are exactly the same between support and resistance. In an ascending and descending triangle, one of the angles is horizontal. In a wedge, the two support and resistance lines are converging towards each other, but at different angles. So the most common wedges are found as breakouts in the opposite direction of the wedge. That is, a bearish breakout is a rising wedge, a bullish breakout in a falling wedge. But then we come to the one you talk about and you read about in the newspapers and the financial news. They're always talking about it in Bloomberg or Market Watch, and they're always referring to the head and shoulders pattern. Now, granted, out there in online trading land, we have people talking about all kinds of things they make up. We have bat wings, we have Spider-Man wedges, we have, what did I see the other day? Well, cups and saucers have been around, but it was a flying saucer with something else that somebody developed this pattern. And they said it's a great pattern. When you see it, it does this. The fact is, it rarely ever occurs. It's not really a pattern. It's just some random things that somebody drew a line around. I saw, what else did I saw volcanic, how was it? Volcanic lava flow, when the price goes up and down, but the on the down slope, the prices are sliding down the down slope. Okay, they're not realistic. They're somebody's fantasy land. But a head and shoulders pattern is well known and well used and studied for years. A head and shoulder pattern describes a price movement that depicts the head and shoulders of a person. Hence the name of head and shoulders. A head and shoulders is a reversal pattern from a bullish trend to a bearish trend. The pattern starts when the price graph crosses the support line upwards before formation of the left shoulder. Okay, that's a lot of talk. So the popular head and shoulder pattern is essentially a triple top, except that instead of prices, all the peaks hitting the same resistance level, the center peak pushes well above. Now, there's all types of formulas where you have to have a 15% rise in the head, okay, to call it a head and shoulders. Some have different slopes of the pattern, but basically, this is a screenshot of a live chart a while ago. This is a head and shoulders. Okay, what you have is prices moving in his merry-old way, paying no attention to anybody, going up and down, and it forms, which you wouldn't see at the beginning, what we call the left shoulder now. This left shoulder is a price moving up, hits a resistance line, and falls back and comes down to support level. Okay. You'd never know it because that is forming a head and shoulders pattern at this point, because it's just a standard operation of price movement. Now, price then bounces off the bottom here and climbs through the resistance level that we saw before, where the top was before, climbs all the way up and hits a new resistance level and bounces back down. It goes right through that, what was resistance and would have been support, and comes down to that previous support level, which is equal to this prior bottom. So what we have is, now we start to see, we have the formation of a left shoulder, the formation of a head, and the formation, or the beginning formation, of a right shoulder, because this is the pattern of a person. Now let's use some common sense here. We have people that have long necks, we have people that have high foreheads, we have people that have hunched shoulders, we have some people that aren't completely straight, we have people that kind of lean sometimes. You might have so all the people out there that want you to have specific definitions are wrong. You have a left shoulder forming. Okay. You have the head forming. The head, whether it's, whether you had a short neck, a long neck, whether you're a short, stocky person with, I've seen guys that their shoulders are basically up in their ears because that's the way they're built. Okay. But you can see the formation of the head and shoulders. You can see the formation of the person. The most important level here is what we call the neckline. That's this line right here where the two bottoms were made. Okay. That is the most important line. If you don't have these bottoms and this neckline, then you don't really have a head and shoulders. You have just price moving. Okay. Now, you would not recognize this in most cases until price hit this bottom and started to bounce off. And there's also nothing you can do until that point. When price hits that second bottom here and bounces off, you have the possible formation of the right shoulder. This right shoulder would then move up and hit the top of the left shoulder. Now, price could continue going up, and up. Pay no attention. Say, ha, I'm not a head and shoulders pattern. But if price bounces off of this shoulder level right here, we then have a completed head and shoulders. Now, so what we have is we can start looking at what we expect as price bounces off to form the right shoulder, but until it actually starts moving up, 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 and coming towards that resistance level, we don't have anything. And then we need to bounce off the resistance before we can make a trading decision. We need the complete head and shoulders. But when it forms, you can see it. And this is, directly, this is not a graphic. Okay. Now, let me pull, I've got a couple charts. Sometimes it's hard to find because no assets are actually trading this. But today I've been able to find a couple. Here we have a chart pattern on this asset. Now this is current trading. This is the current market. And what we see is price moved up, formed the left shoulder, came down, formed the head up here, came down, and formed the right shoulder. And we're waiting for the bounce off the right shoulder to make a trading decision. So in our chart pattern structure, we have our head and shoulders and we have our inverted head and shoulders. Let me just get some of this mess off of the screen. I thought I cleared up the last class, but I guess I didn't. Okay, so right now we have right here, this is the inverted head and shoulders. Come on. Doesn't want to go away. Okay, so and then we have the upright head and shoulders. The normal head and shoulders comes off of an uptrend and gives us a reversal pattern to a downtrend. A inverted head and shoulders comes off of a downtrend and tells us we're moving into an uptrend. I thought I had a third chart for you, but no, I guess I wasn't able to find anything. Oh, we were working on it. I'm sorry. Now, the reason that the neckline and the head are critically important with the head and shoulders is we can start using this pattern to make trading decisions, because contained in this head and shoulders pattern is a whole bunch of information. So we have a formula that's a standard formula. This is not my formula, it's a standard market formula. And this tells us that the target price is equal to the neck minus the neckline. Minus the neckline. So what we would do is we would take, to get our target point, where we expect the price to move to, is we would take this value of whatever, this value right here of whatever that price was, and then we would take the head here, subtract this neckline, and then take the difference and subtract it from the overall neckline. We could then drop that on our chart, and this would give us our target point, which is our level right here. Okay. That target point will allow us to set our take profit level. So we would consider entering the market here. We got the sell signal when the right shoulder broke through the neckline, and that's the price we would want to use for our market entry. We would want to set our target or our stop loss at, depending on whether you're conservative or not, at either the top of the shoulder or at the head. Most of us use the height of the shoulder. And then you have your target point so that you can calculate your risk management, your risk reward ratio. So head and shoulders indicates both the end of a trend and a possible change in the direction of an asset's price. The given pattern is formed in an uptrend representing 3 peaks of the market price arranged at different levels. Two lower peaks called shoulders are located at two sides, and the highest peak called the head. The patterns low are connected by support levels called a neckline. The inverse head and shoulders is exactly the mirror image. It's just coming off of a downtrend and giving us a reversal pattern to an uptrend. Okay. Now, as I mentioned before, the head and shoulders pattern can be classified as a multiple top pattern, except instead of being a triple top, we have two tops and a higher top. Okay. So multiple top chart patterns occur in an ongoing trend and indicate the trend is nearing exhaustion. If a security repeatedly has difficulty surpassing a certain price point, a multiple top pattern may form. As the bullish trend progresses, bulls repeatedly attempt and fail to push price towards the resistance level. Now, double tops are part of this classification. Double tops I ignore entirely. They happen way too often, especially in forex and CFD trading, and especially if we're trading in small time frames. So if we ignore them entirely, we can go to triple tops. Triple tops and bottoms are more reliable because they have to happen 3 times at a specific level without breaking through those levels. Okay. This tells us that there's something definitely going on with price. 3 to me is the magic number. It's got to occur 3 times. 2 times happens way too often. And for a triple top, we have the same basic formula, which is our target price is equal to S minus H. What is that? S is the support level, and H is the pattern's height. The pattern's height is the difference between the support and the top. Okay. And we just take target price as S minus H. That will give us our target price to put on our chart so that then we can calculate our risk-reward ratio. And in a triple bottom, it's just the reverse. Instead of using support, we're using resistance. Now, it's important to always keep in mind that these patterns, especially a head and shoulders pattern and a triple top, triple bottom pattern, are very reliable, but they are only as reliable as the quality of the trend in which they are coming. You know, markets can move all over the place. They can move in weak trends. They can move in strong trends. The more well-developed and the more defined the trend is actually operating in when the pattern occurs, the more reliable or the more well-formed the pattern, and the more we can use it. So I'm always looking for a strong trend to help me when I'm making a trading decision. Okay. And I'm also looking for when we have a breakout. So like when the last shoulder forms and price breaks below that bottom, I want a strong break. I don't want this little insignificant weak breakout. I want a strong break. When I have a double top or double bottom and it breaks out of that pattern, I need a breakout of some significance. And there are many ways we can trade these. There are simple formulas that are always the same. It gives us our stop loss, our entry, and our target. And we simply use these simple little formulas measuring the width of the pattern. So they're not difficult to see. They're not difficult to use, but they're not a trading system. They are not your final thing. I use triangles all the time, and I use triangles with support and resistance and volume. That's basically my whole trading decision. But then I have to have my breakout candle, my confirmation candle. Okay, but I measure the move based on the base of the triangle, like you always do. I use my low of my triangle and low of my pattern to get my stop loss, and I set my target. So remember, chart patterns and their interpretations are well-known parts of technical analysis and charting. They have been around for a very long time, and they work well because they are reliable patterns. So please subscribe, and please watch for our next video where we're going to go into detail on trading with these patterns and also on some of the most unusual patterns. And thank you very much for joining us, and thank you for subscribing to my YouTube channel. Bye now.